Patrick Moonen, Senior Strategist at ING Investment Management, joins us live now from The Hague. Good to see you. Thank you very much indeed for coming on the show. So give me then your analysis, your assessment of how the earnings season has been progressing so far.
Well, if you look at the European earnings season, there are a couple of observations we can make. First observation is that, well, the earnings season in Europe is much weaker than the earnings season in the United States. Not only on the bottom line, but also if you look at revenues and at corporate margins. One of the reasons to explain this is undoubtedly the strength of European currencies versus the dollar. But what also plays a role is, of course, the fact that, well, the European periphery is showing slow or even no growth at all. A second observation that we can make is that the weakness is particularly important in the cyclical sectors, as more particularly in the industrial sectors, whereas more defensive sectors like food and beverage and healthcare, well, they're reporting results that are in line or even slightly better. And then finally, a third observation that we can make is that, well, if you listen to management's outlook, there is clearly a turn for the worse compared to their comments 3 months ago. So meaning that we will probably revise down our earnings estimates for 2011, and we certainly think that globally next year's earnings estimates are far too high.
Let me just come in there and ask you about that then. So right now you're saying a discrepancy between Europe and the US, US generally outperforming Europe this earnings season. What are the prospects for earnings growth then in 2012? Do you expect to see the same thing?
Well, what I do think is that both in the US and in Europe we will see earnings growth that will be single digits, and I think it will be mid to at most 7–8% earnings growth, because we think that corporate margins, which are at historically high levels both in the US and in Europe, well, they will come under pressure, given that global growth will slow down in 2012, and under those circumstances it's very difficult to imagine that corporates will be able to maintain or increase their margins as is currently priced in analyst estimates. So I think that next year we'll see a further slowdown in corporate earnings growth.
And how will that translate into valuations? Could there actually be some good buying opportunities there, and if so, where do you see them?
Well, overall, if you look at valuations, well, they are attractive enough to cope with a soft patch, a moderate slowdown, but they are certainly not low enough to cope with anything more severe than that. So if you would see a continuation of weak macro data and a downward revision of 2012 GDP growth, then I think that market valuations are still too high. So where do we invest currently? Well, we made a switch from, well, cyclical towards more defensive sectors. And our major overweight are now concentrated in healthcare due to, well, it's a combination of reasonably cheap valuation with some high single-digit earnings growth. A second sector that we do privilege for the time being is the IT sector, because we do believe that companies will continue to spend on IT. And the third sector we have an overweight on is the energy sector, because we do believe that commodity prices will continue to be well bid for, given strong emerging markets growth.
That's great. So you like healthcare, technology and energy because it benefits from higher oil prices. Just a very quick 10-second response on your underweight positions.
Well, we are underweight the cyclical part, more particularly our biggest underweight is in the industrial sector, where earnings were weak and where also the outlook is well, less positive than it was a couple of months ago.
Thank you very much indeed. Good to talk to you. Patrick Moonen, Senior Strategist, ING.